Full case study of a full cycle syndication deal. So again, welcome everybody. My name is Leslie Awasom. I'm one of the co-founders and director of operations here at XSITE Capital. I'm here today representing my other co-founders, Mr. Tenny Tolofari, who is here on the call with us today, and esteemed CEO, Dr. Julius Oni, who could not make it here with us today. So I'm being forced to fill in these shoes, which are big shoes to fill in presenting. But thank you guys so much for coming. And we also have our other team members here with us, Mr. Miles Hill, our acquisition associate, Ms. Macy Price, our director of marketing, and Mrs. Kayla Daughtry, our investor relations specialist. We truly appreciate you guys all being here today. So we're going to be doing a case study of one of the deals that we went full cycle on. If you've been anywhere in the multifamily space or been researching multifamily investing over the last few months, I'm sure you've seen deals being advertised or returns being shown or projections being shown. If you're new to the space, you start asking yourself, how are people able to achieve these returns? How does this even work? Is this too good to be true? Does this even make sense? So here at XSITE Capital, we had that aha moment a few years back when we discovered this asset class, which was what really pushed us to start XSITE Capital so we could share this message to members of our community. And so our goal here is to demystify the process to members of our community, to educate as much as possible, to show you, peel back the curtains and show you what happens in the background of this asset class. So this meetup is one of those sessions where we break down everything for you, go through the whole process, and show you how we went from start to finish on an asset. And so you could gain enough knowledge from this, ask any questions that you want, and we'll be happy to answer it. So the story of this asset began way back in 2019 when we started XSITE Capital Investments. We started, as mentioned in the brief intro, we started pretty much with the faith in mind that we have discovered something that is so powerful that members of our community have to be exposed to. But like they say, it takes a bit of time to grow in anything that you do, and that story was not different. The view at St. Andrews is a very special asset to us because it's the very first one where we went full set, where we bought as lead sponsors. This was our first lead sponsor deal. It was a 132-unit apartment building located in Columbia, South Carolina. A really nice location, 15 minutes away from downtown Columbia. And to go into detail on how we were able to even acquire this asset or even take this asset on the contract, I'm going to pass it over to our director of our acquisitions, Mr. Tenny Tolofari, to go through with you the steps that he went through in finding this asset to bring to our community.
Are you talking about me?
Yes, I'm talking about you. Now you can talk.
I'm just kidding. Thank you everybody for joining. Like Leslie had mentioned, this is a very special deal for us. Of course, now we've been able to go ahead and buy a lot of deals. We have $168 million under management right now. But the first one, they say when you get the first one, it opens up doors to a bunch of other opportunities. And I think that's the case here that we've experienced. But like he said, we want to open up a curtain and kind of share with you all some backstory. Hopefully, as we share these stories with every one of you that's attending today, you can learn some things about it. You can learn about the failures, you can learn about the success, you can learn about and if you have questions as we go through these things, please put them in the chat. Let's see how we can help you as you're trying to navigate the market or trying to buy deals or trying to invest in deals, how we can help you in your journey as well. This basically started with, like Leslie mentioned, we started the company in 2019. In 2020, I decided to move to Charlotte, North Carolina, to be boots on the ground to find deals. I think I moved there in August of 2020. And then in September, October, my wife was like, we've moved to Charlotte now. Where's the deal? You said once we move to Charlotte, we're going to get a deal, right? So that, kind of put a lot of pressure on me because I promised her that we're moving because I didn't have any business moving to Charlotte. My job I was doing was in DC. My friends were in DC. My partners are in DC. So I don't have any business here in Charlotte. But I realized that I'm talking to my partners, we realized that in order for we to compete in the marketplace and we want to buy in the Southeast, somebody has to be here. So I sold my home, moved down here, and then my wife now is on my back. Like, dude, where's the deal? So one of the things that we did in order for we to get deals was to think about ways that we can build relationship. And as we all know, relationship is key to anything, be it business, be it personal life, be it friendship. Relationship is a cornerstone to any kind of thing that you're trying to accomplish in this life. And one of the things we identified pretty fast was that the brokers has the keys to the cookie jar. And my partner was like, dude, Tenny, go get to work. Let's just get this going. So one of the brokerage firm that was dominating the Sun Belt at the time was a Cushman organization. And one of the things that we did was to try to identify some of the top brokers in this market. Within these different brokerage firms, Cushman organization stood out. I made one trip to Charleston, South Carolina, where I drove 3 hours to Charleston, 3 hours back, and I met a broker there for 15 minutes. After I met with him, he introduced me to his junior broker. And then in that process, and that's how we got this deal. Now, you would think that immediately I saw him, he gave me the deal. Now, we were, he was sending us deal. We were underwriting. We were providing feedback. We were going and touring deals with them on a frequent basis. And they saw that we were not here to play around. Because once we were on the face long enough, they knew that we were serious. So when this deal, the view at St. Andrews came up, they sent it to us. We underwrote the deal. And so when the deal penciled, Leslie was like, are you joking? This deal is working out. I was like, dude, we've been underwriting hundreds of deals. We finally found one that penciled. Are you scared? They're like, dude, I can't believe that this one penciled. Are you sure we're doing something right? So we reached out to our mentors, reached out to a third party underwriter, and just for them to validate what we're doing to make sure that what we're doing was right and everything checked out. So we submitted an LOI, and guess what? We lost the deal. The broker told us that we were going to get the deal, but unfortunately, they said they gave it to somebody else that have a better track record, that they know better, and blah, blah, blah. But anyways, we moved on from it, went about our business, continued to work with them, continued to ask them questions. And then one night at 9 p.m. in the evening, the broker reached out to me and was like, hey, Tenny, are you still interested in this deal? I was like, what deal are you talking about? Because I pick up my phone anytime. You call me at 2 a.m., I'm picking up my phone. So are you still interested in this deal? He said, absolutely, I'm still interested. He was like, well, you guys are $93,000 per door. Are you willing to come up to $96,000 per door? I was like, well, just give me 1 second. Let me call my partners. I'm about to call my partners out now. So that night I called my partners. I called Leslie on the phone. Leslie was sleeping. I called Julius on the phone. Julius was sleeping. I was like, what's going on with these guys? We need to submit that offer right now. And the broker was like, guys, you got to submit your offer tonight. So what I thought about it was we've already had conversations about the deal. And again, LOI is non-binding. I told them, all right, I'm going to send an LOI for $76,000 per door. And then in the morning, when my partners wake up, I'm going to have a conversation with them and then, we'll go from there. He'll have to send it over. So after I did that, I sent my partners a message. I've made an executive decision to submit an offer on the deal. So they woke up like, Tim, why are you blowing? Leslie wake up very early. So he woke up at like around 5 a.m. and he started calling me like, dude, why are you blowing up my phone in the night? I was like, listen, I just submitted an LOI for a deal. We're on the road to put for 93,000, but I think we have room to go to 96. I submitted an offer. I was like, man, good job. I'm glad you made that decision. So we end up, and that's how we went ahead. They accepted our offer, and that's how we were able to buy the deal. But a couple of lessons from this is a lot of times you put in an offer, you try to get something out of something, and you get rejected. Don't back down. Keep asking. Keep following up with the folks, because at the end of the day, if the person that was upfront backs out, you're going to be the next person in the queue. And guess what? We've had a lot of lessons on that. You know, we've had 2 deals that have a similar story. So basically, that's how we were able to come about the view at St. Andrews. Leslie, am I missing anything? Good.
Just the other point is we have 3 deals that we've come in second place and ended up getting it back. So
yeah. So, and how did we come about this deal? It's pretty simple, right? Where we wanted to buy a deal at is Charlotte, North Carolina, right? And that's why I moved here. But if you all know, Charlotte has been growing at a very exponential pace. There's a lot of migration here. About almost 80 people move here every single day. And that has driven the demand for commercial property, for single family homes and everything. So the competition here in Charlotte was ridiculous. So we were like, okay, where else can we look forward to buying a deal in? So what are the surrounding area that's an hour away, an hour and a half away, 2 hours away that we can buy deals? And when the view came up, you know, it looks like a market that was growing. And some of the reasons why we decided to say, okay, Columbia, South Carolina was a good market was because the market has a huge demand when it comes to growth, because there are a couple of things we look for when we want to buy a deal. We look for median household income growth. We look for population growth. We look for jobs. And I think at the time they announced one job about a stadium that was just recently built at the time in Columbia, South Carolina as well at the time. We look for drivers that help support our investments, because if you think about it, if people move to somewhere, where do they live in first? They live in an apartments, right? And if we can provide a community that these guys can live in, it's a win for us and the residents. So we look at a lot of these economic drivers in order for us to choose a market. And Columbia, South Carolina was the state capital and is one of the fastest growing cities in the Southeast as well. So that's why we chose that market and we decided to buy a deal in that market. And then in addition to that, when we looked at this specific deal, the supply and demand dynamics on that specific deal in that submarket was huge. Now, if you drive an hour to 30 minutes, an hour to 30 minutes to 45 minutes away from that property, you know, the market dynamics is kind of different. But that submarket, the school districts, the crime and population and all of that stuff, actually the school district was one of the best in Columbia, South Carolina. And that's one of that big reason why we chose that particular location. Also, we observed that there's something called meat on the bone or meat on the bone. The owner of the property had done his value add portion of it, and he has left a lot of meat on the bone for us. And we've seen the upside on that deal, that if we're able to come in, implement our business plan right, we'll be able to, of course, make the community great, make our investors a lot of money, and we'll be able to exit. We're planning to hold the deal for 5 years, but we ended up in 21 months. And then, of course, the value add piece is the main story, which I've already mentioned. We came in, saw a lot of value add opportunity where we can come in, help the community look better, put in a lot of amenities, and then from there, we'll be able to increase the value of the property by increasing the rent. So please, next slide, please. Now, so the view at St. Andrews, it was an interesting deal because the first thing I asked the broker when he called me back about the deal was, so what happened while the other group backed out of the deal? Of course, you know, we came second place, and he was like, well, I'm not really sure why they backed out, right? And a lot of times brokers, when they give you any information, you take it with a grain of salt. You're like, okay, but I will verify. I believe you, but I'll verify. Evidently, there were a couple of things on the property that they were not showing us or they were not telling us. And this speaks a lot about us as a company. Before we bring our investors into any deal, we turn everything upside down, right? When it comes to financial analysis, we bring in expert teams. We don't believe that we're 100% expert in everything. What we don't know, we bring in the expert into the picture to come and do it. We do financial audit. We review the loss run with a property insurance company. For example, on this property, a couple of things they did not tell us before we bought the deal, or before we went into LOI was, one, the property had a flood on it. There was, I think there was a shooting or a minor shooting on the property. There was a fire that they said it was on the lost run, and a lot of stuff that was on the lost run. The reason why the other group left was because of the lost run. The lost run showed flood, fire, assault, gun, and all of this stuff. So when we got our own lost run, we're like, okay, let's take a look at this. Let's do our due diligence on it. Let's ask questions. Let's go back in time and try to figure out exactly what the story is. And what we realized that on that lost run, the owner of the property has a comprehensive, and on his comprehensive policy, all the incident that's happening on all his property shows up on that lost run. And a lot of the incident that we were talking about was not applicable to the view at St. Andrews. What was applicable to it was the flood, which affected about 10 units. So we were like, okay, let's go back to the physical inspection and figure out exactly what happened with the flood. And what we realized that the drainage that was adjacent to the property was blocked. And because of the not taking care of it in a long time, it got clogged up. And that's how the property looked for a way, the water looked for a way to go through the property. And that's how all those units got flooded. So we spend a significant amount of time to review financial analysis, do physical inspection, do market analysis. When it comes to market analysis, we go ahead and shop comps. What that means, basically, we want to figure out what's going on with other properties like ours in the market and what are they charging for rent? What are they charging and what kind of amenities do they have? And how can we come in and make our own property very, very competitive, right? Of course, we look at the tenant demographic and of course, we look at our financial projection, which is our performer. And I think Leslie is going to be talking more about the financial projection in a minute. And here I'm going to pass it to Leslie to talk about the investment summary.
All right, thanks, Tenny. And just to add to the due diligence piece, one key important piece, the reason why we were able to really go back and be digging instead of just walking away by hearing all those scary stories was because our property manager, who lives in Colombia and knows this market very well, was telling us that this is a great market, this is a great sub-market, this is a great property. Let's dive in deep. She doesn't think that there's there's much value to that, and we're glad that we listened to her. So one key lesson from that is always get the best experts and leverage the experts. So this property we purchased for a total of $12.55 million, as Tenny mentioned, as that's $96,000 per door. Total capitalization was $14.8 million, and this included our CapEx budget, reserves. At this point in time, this was right in the middle of COVID. So the lenders required a significant amount of reserves, COVID-related reserves, CapEx-related reserves, and also included the fees with the property. So the debt financing was like $9.514 million. And total equity that we raised from investors was $5.362 million. And at the end of our business plan, we were able to sell this property for $17.8 million. So now let's dive into the value add business plan. So for this property, like Tenny mentioned, one of the things that we loved about this property was like it had a ton of meat on the bone, like Tenny says. And what we've learned over the years is that we were really lucky to buy from this particular owner because that is his business strategy, to identify good properties in good neighborhoods. And he doesn't do much on it, like lives it as is. And once the market starts turning, he starts to prove a renovation plan and is able to exit to the next person. We've actually had a chance to have a sit down with him. And the way he explains it is I take it from step 1 to 2, and I pass it over to somebody else to take it from 2 to 4 and pass it to the next person. That's how multifamily investing work, and that's exactly what happened with this property. We took it from step 2 and took it to 4 and then sold it to somebody else. So for this property, we raised $992,000 for renovations. That included a $332,000 for exterior renovations and $660,000 for interior renovations. We initially planned to renovate 88 units with an approximate renovation cost of $7,500. I smile because it's always good when you make these projections than when you get into the property. We were able to actually successfully renovate 33 of the units and not the 88 that we projected. What we did is we remedied exterior defect maintenance. We rebranded the property, improved the community amenities, modernized the interior units, and operational improvements. So these were all part of our business plan going into the property. This is what we plan to do. But as one of the greatest philosophers of our time, Iron Mike Tyson himself says, everybody has a plan until they get punched on the face. It's very typical of multifamily investing. You know, what you see as investors, or what you see projections, you see pro forma, you see business plans of what we think the property is going to happen. But 100% of the time, things never go as planned. Like we like to say, every operator has to be humble enough to realize that pro forma is always 100% wrong, right? So, but what we try to do is to make sure that this pro forma is wrong in a good way. And thankfully, this was one of those assets where because of our conservative approach to underwriting, our pro forma was very wrong in a very good way. But as we took over the asset, we got punched in the face 2 weeks later. I remember because this was our first deal as lead sponsors. We had a meeting in Atlanta, so we were all in Atlanta, and we decided to celebrate a little bit on our first our first lead sponsor deal. And we were driving back. Our intention with Tenny and I was to drive by to Colombia and meet with the team and everybody, have a little pizza, celebratory lunch, and talk about the business plan. An hour away from the property, we get a call from the property manager. There's a fire on the building. You can imagine the thoughts that are going through our heads. Like, first off, is somebody hurt? It's like, what's going on? How bad is it? Oh my goodness, what are we going to tell our investors? All these investors, all these people that trusted us, some 90% of them had never heard about multifamily investing before, but they invested because they trusted us. And now, 2 weeks into ownership, the building is burning down. What are we going to do? All those thoughts are racing through our heads, but gratefully, we were able to leverage each other and say, we're going to drive to the property and see how it is. Then we'll figure out the situation from there. I think our previous experiences help us to be able to manage any crisis situation. And thankfully, it was just one unit that got burned down and was able to be controlled fast by the fire department. Nobody was hurt, thankfully, and the tenant was lodged in a hotel for a few days until we were able to get another unit for her to move her stuff into. And it actually worked out great because insurance actually paid for it, and we were able to use this as one of the first units that we renovated, and actually renovated it for less than what the insurance paid for it. So it actually worked out great. But most importantly, the most important piece of this is, like, we were very transparent with our investors, and all the fears that we had, we were surprised to see that our investors actually appreciated the communication. So if you're an operator on this call, if there's anything you could learn from this, is always be 100% transparent. Our investors were so happy just communicating, letting them know this is what happens, regardless of however we thought they were going to take it. They were very happy, and it worked out great. This was also in the middle of COVID, and a lot of things were changing. You know, we were not sure, like, one of the challenges we faced was with staffing. It was very tough to find people to work at that point in time because the government was paying for people to stay at home. So the COVID came with its own challenges and its own advantages as well. And during our hold as well, there was a shooting on the property where a tenant had a guest that came on the property and had a fight with a neighbor and pulled out a gun. And all these issues, these are things that you do not plan in your business plan, but that you have to deal with. Again, thankfully, nobody was hurt on this one. The tenant was evicted along with the person that was in the fight with that visitor. And we were able to reassure all the tenants on the property. And again, always making sure that we notify our partners, our investors along this journey. And we experienced significant supply chain issues. That was probably one of the reasons why we were just able to renovate 33 units. Like, it was very tough to find items like pool supplies, unit supplies. Everything was delayed. you know, so our timing was a little off on a lot of the renovations. So these are all common challenges that come with every multifamily acquisition. Like there hasn't been any deal that we've purchased since this one that hasn't come with its own set of challenges. But the challenges we faced on this one helped us prepare for the subsequent deals. And here are some of the things that we did on this property. When we bought this property, it was called Churchill at St. Andrews, a nice name, really appropriate for the 70s. So we had to rebrand it, bring it back to the 2020s, and we changed the name to the View at St. Andrews. And you can see the changes that we did in the sign, from the dated sign that it was to the newer one. And this also helped our marketing, helped changing the impression of the tenants on the property, letting them know things are improving on the property. We did a lot of residings on the building. Obviously, this building was built in the 70s, so it's not uncommon to start seeing some wear and tear or some deferred maintenance. As soon as we got in, we started taking care of all these deferred maintenance items, started doing the work on the exterior to show the residents that changes were happening on the property. We did a lot of improvement on the amenities. We added a nice playground for our residents. This is a really family-oriented community, so we wanted to keep it that way. Wanted to make it a nice community for families to be able to enjoy. We also really renovated the pool area, brought in newer pool furniture, made it nicer for the residents. Did significant amount of work in modernizing the 33 units that we renovated. As you can see, this is what they look like. Again, like something from the 70s, and we were able to renovate it, change the countertops, change like add backsplash, change the cabinet doors, repainted the cabinets, you know, change the flooring to a more updated flooring. Same thing with the bathroom, and residents really appreciated this. You know, we projected that we were going to be able to increase rents by $150 on the renovated units, but we ended up achieving more than that on our renovated units. So the value add business plan worked out great despite all the challenges with the supply chain issues. However, one big thing that changed a lot was the cost of these renovations. Like I said, our plan was to renovate these units at $7,500 per unit, but because of the supply chain issues and everything that came along with COVID, this ended up costing more. And we ended up having to renovate this at close to $10,000 per unit. But because we underwrote the property going in with a lot of reserves, this did not affect our business plan in a negative way. You can see some more changes that were done on the property. This is what the leasing office looked like, very dated, like something really from the 70s. We were able to update it, change it completely, add nice flooring, add nicer furniture. We also added a spin studio to where you see this door right here. There was a spin studio in there. So we added that. It made the property look really nice. With our third-party management company, we were able, because of these changes that we did to this property, we actually won the award, the beautification award given by the Columbia Apartment Association for the most improved property, the property that has been taken from an ugly duckling to something nicer. And the View at St. Andrews actually won that award, which is something that we're very, very proud of, because the business of acquiring multifamily assets is not just about creating returns for investors. It's most importantly of all, it's about improving communities for residents, for families. Because in this property, we had at least 132 families residing on this property. So when we create a nice community, improve the amenities for these families to enjoy, then and only then are we able to create the returns for our investors that we project. As you can see, this is what premiums we're able to achieve. Like I mentioned, we projected $150 rent bumps on renovations, but totally we were able to achieve averagely for all the units that we turned about $177 in rental premium, which was good. Now, what does all of this means to an investor? What does all of this means to somebody that invested? Now, before I even get into that, I'm just going to talk a little bit about how we were able to raise the funds acquire this property. One of the key things that we did early on in our journey, when we started XSITE Capital, we actually had an opportunity to be part of another deal as partners, and we were supposed to raise a certain amount of money, which we failed at woefully. I was not even able to raise $1,000. So when we had that failure, we had to come back to the drawing board and ask ourselves, what are we doing wrong? We have such a great opportunity here to provide an asset class to members of our community that could really benefit from. It's a great asset. We invest in it. We see the benefit. How come we're not able to change that message, to give that message to members of our community for them to see that there's a value in this? And things that changed because of that. Initially, it was Tenny and I hitting the pavement running. Dr. Oni came in and became our savior and was able to open our eyes to the power of educating our members of our community about this asset class, to the power of going out there and spreading this gospel of multifamily investing, which he took the lead on. So what led to our success the most was the value that we were creating, that we were giving. Even before we had a deal, we were educating. We were providing free educational courses. We've been running a free underwriting class for over 2 years prior to even having the deal. We were doing the monthly meetups. We were educating everybody that we could see or share the knowledge, giving. And that was the secret sauce, being able to give value to a ton of people. And when the time came needing to raise $5.3 million, which is a number we thought was outrageous when we started, we were able to do that in a relatively fast until a point where we had to turn away some money. So if you're an operator and you are listening to this, you're looking to raise money, now is the time. Start educating people, start giving value, because that value you give is what is going to lead to your raise in the future. So with our investors, whom we raised $5.3 million from, 90% of our investors were our friends, colleagues, family members. A lot of them just invested because they believed in us and they trusted with us, which is something that we take very, very seriously here at XSITE Capital. So when we go in with our projections are very, very conservative. We project with numbers that we know if things go well, we should be able to achieve it. That was our approach with the view at St. Andrews. We projected a net IRR of 16%, cash on cash of 7%, and an equity multiple of 1.9x over 60 months. But we were able to outshoot that in a very short period of time. In 21 months, we achieved 28.8 IRR. That translates to about 30% average annual return, with a 7.1% net cash on cash and 1.5x equity multiple in 21 months. This was way better than what we projected or what we ever thought we were going to achieve on the asset. As a matter of fact, one of the reasons why we decided to exit out of this asset is because we surpassed our exit price after 21 months of ownership. And we felt it was the right time for us to give our investors back some money or give them an opportunity to roll that money tax-free to another asset so they could continue to grow their wealth. And this is what it looks like. A lot of times we thought the best way to invest in the stock market, which is a great way to invest, but it is also very important that we diversify out to uncorrelated assets. That is, assets that are not correlated to the stock market. So this particular slide shows how uncorrelated the view at St. Andrews is to the stock market, or how uncorrelated these assets are to the stock market. So it doesn't matter what's happening in the stock market. What is important is what is happening on this asset. So that is what determines the returns on this asset. So our investors on this asset, anybody that invested $100,000, this is what their return looked like over the whole period. They received cash flow every quarter. And on December 2022, when we exited, the initial investment was returned. And the forced appreciation too was also given out to the investors. Some investors elected to 1031 this appreciation over to another asset. But when we add all those returns that they received during the hold and on exit, it translates to about $2,500 in monthly income. That is passive income. This is income that they earn without needing to lift another finger. So that is how powerful these assets are when managed correctly. The view at St. Andrews is a great example of how you could grow investors' wealth by investing in multifamily assets. So a brief summary of the investment. Again, as recap, we purchased this property for $12.55 million. That's $95,000 per door. We improved the overall look of the property, rebranded it, did a lot of exterior renovations. We held this property for 21 months. Our average cash on cash over those 21 months was 7.1%. Our passive investors received 30% average annual returns. That is after we sold it for $17.8 million. I'll have to note here to say that when we purchased this asset in 2021 at $95,000 per door, this was the highest price asset at that point in time in this sub-market. And I remember getting a question from another investor, like, why are you guys buying this property so high? But the fundamentals made sense. This is a case in point to point that multifamily does not necessarily work as single family where you're looking at comps based on price. The fundamentals made sense because the rents on this property were very low compared to the market. So we saw a huge delta where we knew we'll be able to increase the value by doing our renovations and be able to capture already proven value add business plan on that property and be able to exit out. And as you can see, just over 21 months, this property appreciated by about $40,000 per door in 21 months. That is how powerful this asset class is. And the reason for that appreciation was what we were able to do on the asset by significantly increasing the net operating income, and everything too that was happening at that point in time with increase in rents with inflation and cap rates that were getting a little bit more compressed at that point in time. So we had a trifecta of great things happening from us, from the operation to the market, that helped us to be able to exit this property in a very short period of time and give significant returns to our investors. Again, this was done thanks to the fantastic team that we've built here at XSITE. In the introduction, I forgot to mention one very key and important member of our team. That is Manny Awasom, our underwriting specialist. I remember this asset in the middle of the night, how we went back and forth on the numbers, looking at all this stuff. He's a very conservative guy. So when he says this one works, this one works, you know, I knew that any doubts I had were based on my fear because the numbers guy said this one works. So the asset did work, and we are grateful that we're able to give these returns to our investors. So that's a synopsis of the view at St. Andrews. We'll be more than happy to answer any questions which anybody has. Since then, we've gone again and acquired more assets, which are listed here for a total portfolio value of $168 million. And again, to all of our investors on this call today, we cannot say thank you enough. There is absolutely no way that we'll be able to do all of this without you. We truly appreciate you, and we are committed to continuing to work as hard to deliver better than the view returns to the rest of the assets that we have in our portfolio. On that note, I'm going to say thank you. If you're on here and you want to learn more about what we do, or you're interested in any of our upcoming opportunities, text wealth to 301-265-2056. Again, that's wealth to 301-265-2056. And our amazing Kayla Daughtry will reach out to you and understand your goals and see if our opportunities are a right fit for you. On that note, I'm going to end here. Thank you. Thanks, everybody.
Good job, Leslie. I see you've been practicing a lot. Good job. Good job. Yeah, everybody, this is the time to ask questions. Again, we shared this for in full transparency for anyone that have questions, to ask questions where you can learn and dissect and take some things back to yourself and then see how you can use it to how to improve your business or whatever. So please feel free to come on camera if you want, or if you want to put it on the chat. I see Dr. Audrey Marco right now raising his hands. Please go ahead.
Sure. First off, it was a great presentation, and I learned a lot in just a short period of time. One question I have about these syndication models. You raise capital, and do you raise capital to meet the purchase price, or do you raise over and above the purchase price to create a reserve? And how much reserve do you need? I'm sure that's an underwriting question. And then of that amount that you raise, I presume over and above the purchase price, how much of that capital is used to support cash on cash returns in the first year of the deal, so you can meet your investors' goals? Is that what the reserve is used for, or is it used for other purposes to meet cash on cash, or is that totally not done?
That's a very good question, Dr. Michael. So for these properties, the purchase price, as you could see from the view example, the purchase price was 12.5 million, but we raised 14 million. So that extra capital, part of it, I think it was about 3-point-something million was going towards a down payment of the asset. And the lender gave $9.5 million as part of the loan. The rest of that was raised as the CapEx. Our CapEx budget was a total of $990,000. So that went into the renovations, the cost to renovate the exterior and the cost to renovate the interior, which will hold that amount in reserves and as we start renovating. We also raised a reserve amount, right? It's very important that you have reserves for when things don't go well, which we typically raise about 1.5% of the purchase price that we have in reserves for these assets. That's what we use in case of any surprises. Then for this particular property, at that point in time, the lenders required a COVID reserve, right? They required an extra reserve of about $262,000 that was gone towards COVID in case we run into any issues with COVID and we are unable to pay our debt service. They were going to tap into that reserve and use that to cover for that. And then we also raised an acquisition fee, which is the fee paid to the operators in the start of the business for bringing everything together and putting everything together. So that's what totaled that $14.5 million. So when we underwrite a property, we underwrite the projections we gave on cash is based on what the property will produce, right? We typically do not give projections. We typically do not raise funds to pay the pref, right? But if we do run into a situation where, for example, we're doing a renovation, there's some delay, we've had to tap into our reserve to pay for stuff, or there's some delay in the income coming to us, we could tap into the reserves to pay the pref and then replace it from the operations on the property. So we typically do not raise to pay the pref, but I know for some heavy value add deals or some repositioning deals, it's not unusual for operators to raise some funds to cover for any any pref shortcomings that they have along the way. But typically we project based on what we see on the asset.
Okay. Thank you. That's a great answer. Appreciate it.
You're welcome.
So Leslie, we have a question from Roscoe. He says, what's the minimum investment?
Roscoe, for
minimum
you,
amount to invest.
Roscoe, for you is $500,000, but for everybody else is 50.
And we have a question from MC. Do we get this slide via email?
So you're gonna get the presentation, the Zoom, the recording of the presentation, and that should include the slide as well. So.
Hey Leslie, I had a follow-up question when it comes to reserves. I'm glad Dr. Michael asked that. But at one point, does the lender release the reserves back?
That's a very good question, Miles. So that's exactly what happened. So there was all this fear about COVID. Everybody was so afraid, need all these reserves. Then the COVID came and then things got stable. Like people were not moving out. Delinquencies were low because the government was paying everybody. So what did the people do? They paid their rent first, right? So vacancies were low. Multifamily demand was high. Rents were increasing, right? So there was no need for the lenders to hold the reserve. So 6 months into our ownership, the lender reached out to us and said, hey, we have no need for these reserves again. So They released it to us. But the plan was for them to hold it for the first 2 years of ownership. But they were able to release it back to us after 6 months. So that is one of the things that worked in our favor on this asset, because at the very first year, we became very, very highly capitalized, where we could weather like any storm that came because we had a lot of money in reserves.
Thank you.
Please keep the question coming.
I'll follow it up with another question. When it comes to the supply chain issues, I know COVID drove a lot of that. How did we mitigate that? Like, I know the original business plan was to renovate around like 5 units per month. I know the supply chain issues slowed that down. How did we go about mitigating? Did we just buy wholesale? Or?
Well, one of the main things that slowed us down on the renovation was the lack of units to renovate. Occupancy stayed high. We were achieving organic rent growth on some units for like $100, $150, and nobody was moving, right? So we ended up having to renovate about 3 units per month when we started the interior renovation plan. The supply chain really affected us when it came to like the exterior renovations. Like the pool took forever for us to renovate. Took way longer than we anticipated. Because some of the things that were needed in the office, especially furniture, took a long time to get there. Some of the other stuff that were needed to rebuild, like the flooring, took a long time to get there. And the other issue to that COVID caused was like staffing. We struggled with having a maintenance person, a full-time maintenance person on site. The person we inherited, we had to let him go because he wasn't doing what we were supposed to do after about a few months, and it took us a while before we could find somebody. So those are some of the challenges that we faced because of the changes due to the COVID crisis.
Good question, Miles. Again, everybody, this is the opportunity to ask questions. I know for some of us, this might look, sound complicated. Our goal is to try to demystify it, try to break it down to as simple as it is. Like he said, when we started, raising $1 million was like, oh my God, where are we going to get $1 million? Who are we going to talk to get that done? But with persistence, networking, learning, and continuing to forge forward with a goal in mind. Now, last year we raised $23 million last year for all the deals that we did. And it's possible for anybody that's looking to do that. And that's why we're having these meetups, to let you understand that, hey, it's not rocket science. It's possible to be done. And any question that you have, this is the opportunity for us to be able to answer those. I think somebody dropped a question here. Is it what percentage of the sales price is kept to mitigate any issue that might arise post-sale? How long are the funds kept, when do you distribute them to investors?
So that's a great question. Actually, what we did for this asset, again, we always go with our investors, putting our investors up front. So when we structured the deal, we had a 1% capital transaction fee, which means that the operators at the end get a 1% fee when we sell the asset. So what we did for this asset is we held that 1% capital transaction fee to the operators. It's still being held right now. We decided we're going to hold it for at least 8 months so that anything that comes, we're going to pay it out of that capital transaction fee. So our investors got their full returns, 100% of their returns. And what actually happened is the operators, the GP will end up getting less than 1% of that capital transaction amount because some other bills came about that we had to pay out of that account. So, but we are deciding to shoulder that and give our investors 100% of their returns than to hold their returns for a long period of time. So that's just the way we decided to do it on this asset. I know everybody doesn't do it that way, but that's what we did for this one.
And that's a very, very good question too, to add to what Leslie just said, is a lot of people, they sell, all right, let's go celebrate. Let's blow all the profits. That's not how it works. He says we charge a 1% capital transaction fee on each deal. The reason why is because the process of buying a deal is the same process of selling the deal. You have to go through property inspection, those guys have to send a request for a bunch of financials. You got to answer all those questions. You got to do everything like when you're buying the deal with the person that's trying to buy it as well. So that's why that capital transaction fee is there. And we made sure we put money in reserve in case things start popping up, because you never can tell. Somebody might just come up and be like, well, you owe us this bill. And if you don't have those funds somewhere, you have to bring it out from your pocket to pay it. There's another question here from
Kai had his hand up. You want him to go first before we ask the other question? Go ahead, Kai.
Yeah, Mr. Green, go ahead, man.
Leslie, how's it going, everybody? So my question is in regards to the case study that we just looked at, in regards to the tenant profile. When you guys are analyzing a deal, what is like some red flag indicators that you guys look at that might be like, this might be a deterrent? Because I'm thinking about it from the standpoint of when the value add is done and then you guys have to raise rents. How are you able to essentially raise the rents when your tenant profile is off? And then what ways are you guys going about essentially creating your ideal tenant profile so that you can effectively raise rents and get your return on investment?
So that's a great question. So we do not create the tenant profile, Kai. We identify the right tenant profile to invest with. So the median household income on this asset was about $60,000. So we knew with the projections of rent increases that we had, it was still way below the 1/3 that affordability for household income on this asset. So we knew that the tenants of this asset had the income to be able to afford any increases, or the tenants in this whole submarket had the income to be able to afford that. So what we do is we identify submarkets, properties that have tenants that have a median household income that is high enough to support the rent changes that might happen along the business plan. Then we go into those assets. If we see a property where the median household income is low, and we're not gonna go in there because you can't really change the tenants like that unless you completely reposition the building and get everybody out, then you're able to do that. But that's not typically how we approach. That's not a business plan that we approach. So there were another question of we talked about that one. Is there an in-house property manager or is delegated to outside vendor? So Deji, we use third-party property management for all of our assets. And we identify great third-party property management companies and we build long-term relationships with them. We leave to Caesar what belongs to Caesar. Let the experts in property management manage the asset, and we'll focus on like managing the property manager. Any challenges? Absolutely. We kind of went through some of the challenges that we faced, from having a fire in the building to changes in the renovation price for units, to shooting in the building, to staffing challenges. So there's never, ever going to be an asset or multifamily asset that you acquire without experiencing some challenges. That's never going to happen. There are always going to be challenges. So as an operator or as an investor, you want to make sure that your operator is transparent enough to tell you about the challenges. And when you hear about the challenges, you do not panic, because this is just part of the process. And as an operator, you want to make sure that you're ready to deal with these challenges and communicate with your investors.
Yeah, and then for those challenges, you want to make sure you identify it's risk management, right? You identify what are some of the potential risks, and then you put countermeasures to make sure that when this risk appears, you have things to take care of it. For example, the fire situation. One of the reasons why we were not screaming out loud, like, oh my God, we're dead, business is over, let's pack shop, is because we had insurance. We made sure at closing, we had insurance in place, where that's we're signing the paperwork that we're closing that day, the insurance kicks in right away. So that if anything happens, slip and fall, fire, anything, there's insurance that's going to take care of it. And that was one of the things that we did. So we called our mentor, like, dude, there's a fire in the property, what do we do? And he's like, dude, why you guys panicking? It's okay, everything is gonna be fine. You guys have insurance? Yes, we do. and that's how we were able to take care of that situation. And as we continue for example, for the increase in value add that Leslie talked about, we had a lot of money that we have in reserve to be able to, manage all of that stuff, right? So you just want to make sure you identify the risk and then you put in a countermeasure as you go into your business.
I think there's some more questions there, Tenny.
They say, how many people on an average invested? This is from MC. How many people on an average invested in the first deal? At what amounts? How did they raise the capital themselves on average?
I believe
we had about 68 investors.
Is that correct, Mouse?
No, I got it here. I'll answer the first two questions. Leslie, if you would take the last one.
Go ahead.
I'm not sure who asked that question, but we had 40 investors on the view and an average investment of 54,000. So it ranges, but averaged out 54,000.
Yeah. So these investors, we raised the capital ourselves from our community of investors, other healthcare professionals or other busy professionals like ourselves. That's where we raised the capital from. We don't use it. We haven't used any institutional capital. So all of our investors are like retail investors, like the people on this call.
And a lot of them use their, self-directed IRA. Some of them use their savings account. Some of them have money under their bed. They went and pulled it out and sent it to us. So basically,
I see one on this call that had money under the bed, but I'm not gonna say who. So I'll just leave it there.
So a lot of people that have a job currently, unfortunately, you're not able to tap into that resources to invest. But folks that have left their previous job, a lot of us, that's how we invest, because a lot of these deals we invest ourselves as well, because we're looking to grow our wealth as well. So a lot of us use our past 401k from our previous job, roll them to a self-directed IRA, and then we use that to invest. So that's how a lot of people invest it.
And there's a question of what's the criteria for investors outside the United States to invest. So you just have to create a U.S. entity, work with an attorney that works with international investors. But the process usually is to create a U.S. entity that represents you as the investor here in the U.S. and then you invest. You could finance that entity and the entity invest. If you're trying to learn more about this, just text that number and set up some time. Reach out to Kayla and set up some time for us to talk. We might be able to provide some resources, people you could talk to help you out with that. Do you guys go ahead?
No, go ahead, Leslie.
So do you guys allow other investment entities to invest? Say my brother and I have an investment firm. Also, would the same initial investment be the same for an individual? Yes, that is correct, Gerald. An entity is still corrected is considered as an individual investor. So the entity, if it's a 506 deal, the entity has to be, all the members have to be accredited. If it's a 506B, that doesn't matter. The minimum investment amount is the same, $50,000 for an entity as well as an individual investor.
Gerald, for you and your brother is 100,000, 50-50. Two. I'm just kidding.
Can I ask a quick question?
Yes.
No.
I have two.
Please go ahead.
My first question is, how has underwriting changed today, like in this market versus what you guys were doing, say, in 2020? So are you underwriting more deals? Are criteria changing? How has that kind of affected deal flow today?
Manny on the call.
Manny, do you want to take that question?
Is Manny on the call? Where's Manny? Manny, please.
Yeah, I can take that. Can you guys hear me?
Yes.
Yes, sir.
Yeah, Dr. Kim, I would say a few of the things that have changed. One that stands out is the rent growth. I think a lot of people are more conservative now, and speaking for us, I'll just speak for XSITE. So we're very conservative on the rent growth. In the past couple of years, the industry standard has been like 2%, 3%. I think most markets like Texas, a lot of people are doing like 4%, 5%. So for us, for the markets that we specialize in, so in the Southeast, so Georgia, South Carolina, North Carolina, if you look at a lot of the CoStar reports for a lot of those MSAs, they show very little rent growth in the next year. then about like 2% and 3%. So most of our deals, I try to keep it at 0 just to see for that first year to see if the deal works, and then maybe go up to like 1% and then 2%. If at anything, stabilize it at like 3% in like year 4 or like year 3, depending on the location. It's very location dependent. Some locations have like haven't seen any like rents changes, so those you can kind of do like 1% or 2%. So I would say the rent growth, interest rates, of course, that is more of a market factor, not a property factor. So you really can't change that. I don't try to fight the market or the Fed. So, and especially in this environment where like the 10-year treasury is changing at such a rapid rate. So when you underwrite your deal, even if you get a quote from the broker, try to add a few basis points. So maybe like 20 basis points on top of the rate you get. Just because if you follow the 10-year treasury, that changes on a daily basis. So you might get a quote for say 5.9% today. And then by the time you close, your interest rate is like 6.2%. So rent growth, interest rates, so you want to be very conservative with that. And then, not to make this long, but cap rates. I think there's been a significant expansion in cap rates. So we really try to be conservative. Try to pay attention to the market cap rate, where the market is versus the property cap rate, what the broker is telling you. And again, that cap rates just help you to kind of estimate what your reversion cap rate is going to be. So if you put in trash going in, it's going to spit out trash in terms of what your exit cap rate is. And then so you're going to be overestimating what your projections are going to be on exit. So you just want to be conservative with your going in cap rate, because that helps you to estimate your exit cap rate. And another thing that we've done the past couple of years, the industry standard has been to like grow that entry cap rate by 10 basis points per year. So now for a lot of our deals, we're doing like 12 or maybe even 15%. I was doing, I'd say 12%, 12 basis points, but I think I'm going to increase that to like 15 basis points going forward. Just because the interest rates are changing at such a rapid pace and cap rates are being expanded. So the future is not as bright as it was previously. So you just want to be conservative. It's better to be rewarded in the end than try to be too aggressive and you can't sell it for what you project. So I would say the rent growth, take a look at the rent growth, be conservative on your underwriting interest rate between the time you put in your LOI and exit, the cap rates. Yeah, those three.
Yeah, and that's why we don't have a deal. Because we're very, very conservative.
Real quickly, Manny, thank you for that. One last question. So your meetups, I know it was virtual now. One, was it always virtual? And then two, what was the structure? Was it educational? Was it just come, let's figure out what people are doing? How did you kind of structure it in the beginning?
In the beginning, it was just come listen to Tenny talk, and he would just talk people's head off. And then it evolved from there to us starting to provide value content. So one of the things that Tenny is really good at is connecting with people, and all we had to do was just say, let's provide this value, and he'll go find somebody to come and present. So we started off in person, then COVID came, and everything got shut down. So we had to make adjustments, and that's how we navigated to virtual. And the virtual has been working really well, because now we could reach people all over the globe. We have people in Nigeria actually watching our meetup, all over the world, people joining from France. So the virtual is giving us more reach. And we come into the meetup with one aim in mind: how can we give value to members of our community? So that's what we think about when we decide what to host in the meetup. We just want to give value, continue to give value. So if there's anything that you want to learn about, you're part of this community, there's anything that you think we should talk about, please drop it in the chat, reach out to us. We'll make sure we'll provide that value to you. Did that answer your question, Dr.
Thank you.
Yeah.
And I started one meetup now in Charlotte. Kai right now, he's somebody that comes to the meetup, and we have a couple of folks too that, yeah. So you can do in-person meetup if you want to do in-person meetup, so that they can meet you too as well. And they have a question. We have another question here from Gerard. He said, "How have the current increase in interest rate affected you guys' investment strategy?"
Yeah, I was gonna say,
Manny.
yeah, I was gonna say for that, in terms of underwriting, like I mentioned before, you don't want to fight the Fed. So if you look at the fundamentals in real estate, I mean, it's still pretty much strong. Rent is still, for the most part, stabilized. They're coming down in certain markets, but it's still strong. So you still do the same thing. Don't try to fight the Fed. Don't try to cut corners. Still continue to follow your fundamentals with underwriting. And then if it comes at a lower price, you offer a lower price. And that's the challenge that we've been facing now, because a lot of the properties that we underwrite come at a 20% to 30% below asking, literally almost every single property. But stick to your fundamentals. You know, like interest rates are going to keep changing. You know, the Fed is going to do what the Fed does. So just stick to the fundamentals, stick to your strategy, and if it comes below asking, that's what you tell the brokers. And another thing that we do that Tenny does a good job at is when we come up with our numbers and they're significantly lower than asking, we'll offer it to the broker and ask them if they want to discuss on the deal, right? If they disagree with our numbers, I'm always willing to get on to sit down and we can review numbers and tell them why we're arriving at where we're arriving. So to that, I wouldn't say it's changed our strategy so much. We're just sticking to the fundamentals and doing the same thing that we've been doing. If the numbers work, they work. If they don't, we pass on it.
And one very important thing that this has done for us, trust me, I want us to buy the whole deal involved right now. You say deal, I'm buying. But the team that we have, what this conservative underwriting has done for us is, I'm not sure if everybody's aware, a lot of people are doing capital call. A lot of people are, trying to figure out how they can get out of their deal right now. XSITE Capital was still doing distribution, right? We're not panicking because of some of these things that Manny just mentioned that we do on a daily basis to make sure that we're very conservative in our underwriting. Just to start, we submit close to 2 LOIs every week on deals to try to get something, right? And in order for we to get there, Manny has to go through it. Leslie has to put it. We all and sticking with these fundamentals that he just mentioned. In order for us to present the right investment to our investors. What else? Did somebody else? Okay.
I don't think we have any other questions. If anybody wants to come on camera and introduce themselves and talk about what they do, share some value to the community as well, this is your moment. Don't be shy.
So this is we've moved over to the networking part, right?
Yes.
All right, everybody, come on camera. That's it.
Hey, we do have one more question in the chat. Abigail asked, she's just now figuring out about the 401k to self-directed IRA. Can we elaborate on that?
Yeah, I think Tenny responded for her to reach out to the chat, but essentially you could use a self-directed IRA to invest in alternative assets. There are certain companies that help you set it up. We have relationships with few, which you could verify with them and see. We've worked with Advanta, and we've worked with who else that will help you in rolling over your 401k to a self-directed IRA, and we can provide
trust.
And
preferred trust.
Yeah, so we could provide you those contact informations. Please do your due diligence with anyone. Make sure that the fees match with you. We do not have any affiliation with these companies, but we've used them in the past and they've done a great job for some of our investors. So yeah, so we could help do the introduction for you, Abigail. Just reach out. Looks like Deji came on camera, so it's over to you, Deji. You're muted.
He's trying to
Hello?
fix it.
Hey.
How you doing?
Sorry. Yeah, I actually didn't know I was on camera, but that's fine. Yeah, great presentation. I'm actually just about to park now. My name is Deji. I'm a CRNA, like Leslie, good man. I actually have 52K waiting in an Advanta account now because I missed the Baltimore deal. I was actually kind of in a learning curve with just trying to move my money and all those things. So I'm anxiously waiting. Either way, in the meantime, I'm investing in multi-units. Me and my wife has been investing in Baltimore area. We're based in Southern Maryland right now, but we've been investing in Baltimore. We're currently rehabbing a 3-unit property in right kind of off West Baltimore area. Yeah, we found the contractor through a painting job we needed at our house, and the painter referred us to a contractor, and he's been running point on our project. It's a 3-unit, 2 units, and we're currently converting the 3rd floor to a 2-1, 2-bedroom, 1-bath. So that's kind of where we're at now. We already have 1 unit in West Lombard, also in Baltimore, is a row house, and that's been rented out pretty smoothly with the property manager. The property manager we originally had they didn't want to property manage any more Baltimore properties, so we're shopping for a 2nd one. So that's why I kind of asked about property management, because we're professionals, right? And we need to have reliable partners in this process. So that's really it. We're still in our learning curve. There's a lot of learning as you go. So yeah, that's really been my process. Question: with the Advanta account, what documents is it a smooth like transition if there was a deal today? What's exactly the process?
It's very smooth. Advanta usually reaches out to us. We supply them with the documents for the deal, all the legal documents, which they review and keep on file. And then they wire the funds in, and then your IRA is listed as the investor, and all of your returns go back to the IRA. So it's a very smooth, seamless process. We just once you're ready to invest, you let us know. Then we'll send an email to your Advanta rep and let them know and provide all the information they need.
I'm ready for the deal. I'm ready.
Tell Tenny, man. I've been telling him.
I'm ready for the
find a deal for us.
Inflation is calling me. It's knocking on my door. I'm waiting to see what's going on. But thank you for the
You're
presentation.
Welcome. All right. I think OB is on camera as well. You can say, don't be shy. You can say a word. You're muted.
Oh, just saying hello. I'm a novice and I'm just listening.
Welcome. We're grateful to have you. Thank you for taking the time to join us. And reach out if you have any questions, man.
Sure.
All right, Gerald.
All right, Gerald, go ahead.
Hey,
what's up, big guy?
Man, long time.
I know.
For those of you who don't know, Leslie and I are classmates. So don't let the gray fool you. Somewhere in that black beard of his, there's some gray in there. But you know, I've been listening to you guys. I've been following you guys on Facebook for a good 2 to 3 years, and I talked to Leslie. I think it was sometime last year. He kind of gave me a little bit of insight, even though he was on vacation. I appreciated my brother. He took some time from his family vacation, sat down with me for about a good 45 minutes, and we just kind of had a good heart-to-heart talk. And then you know, I worked at the bank. I was working at a bank. I don't want to really say the name of the bank, but I worked there for about a good 20 years. And COVID came and I got laid off. And I started a business, which I wish I had done that 20 years ago, because in 3 months of starting the business, I was making the income that I was doing at the bank. And I was like, damn, man, I was like, but you know, God gives you what God gonna give you what you can't handle. Yeah, I couldn't handle it back then, but you know, putting things in perspective, I'm happy I did. So I've been kind of trying to figure out what to do with my retirement investments that I had sitting at the bank, and I've just been pondering on it. And again, you guys came up again on Facebook, and I was like, oh, I forgot. I think I missed one other seminar you were hosting. I registered for it, but I got caught up with work and business and stuff, and I missed it. So this time I've registered again, and I'm glad I did, because one of the things that you said that kind of piqued my interest, and I was like, 20 years in the bank. Why didn't I think about that, right? IRA, move that thing from that 401k, put it in an IRA and let it and self-invest and all that stuff. And well, again, I was doing capital financing. I wasn't doing investing. So maybe that's why I missed out on that one. But I appreciate that angle. Thanks for giving that heads up. I really, I think it was a good angle for people who are trying to get in and not understanding the options that they have. Because a lot of times there's so many options that we have, especially if you've just been a working man. You do have those options. And I'm glad you guys are bringing that to this community, because a lot of times we don't know that we do have those little tiny little options to make a different impact, future wealth for ourselves and our kids. So again, hats off to you guys. Thank you so much. Hey, I'll be in DC in September. I'll catch you up there, brother.
Definitely, man. Let's make something happen. Hit me up when you get in town, man. I appreciate you joining tonight.
Yes, sir. And I got the text, so I'm gonna text that to you guys, and I'll get with your team and we'll start put something together.
All right, Gerard.
Thanks, Gerard. Thanks for coming up. Hey, everybody, very important. We all had jobs. Everybody had jobs, had 401k. Me personally, I have to speak for myself. I use this self-directed. When I knew that this was possible, I'm like, why is my money in that account? So, like I said earlier, we make sure we invest in these deals too, alongside our investors. Every single one of our deals. Me, Leslie, and Julius were like, listen, how much do we want to put in this deal? And then either we'll bring it personally and say, okay, we want to bring our personal funds, or we come in and say, okay, how do we want to do it as a group? But we'll make sure we invest in these deals. And this self-directed area has been they're very, very responsive. They reach out to you, ask questions, make sure your funds are there. And there are a lot of other nuggets, but that's going to be for another conversation if you want to learn more. But it's really, really, really good.
And Macy dropped the link to our YouTube channel, which has all of our previous meetups. Please use it, educate yourself. We're really glad that you're here, even if you're just thinking about it for the first time. And to hear someone like Gerald, what we're noticing is now people that have been listening to us over 3 years ago, 4 years ago, again, and this is a lesson to anyone that is looking to do this active. It takes time. Anything you're doing is going to take time. As long as you stay consistent in what you're doing, continue to provide value, it builds, it continues to build over time. Like when people hear this for the first time, it sounds like a very foreign concept, but the more you keep going, the more you keep giving value, now it becomes more real to a lot of people. So we're really just grateful for anybody that has been out there just listening to us all this while, even taking their time to listen to us or pay attention to us and coming in and trying to be part of this journey. We really do appreciate you guys. The journey to growing wealth is a time journey. This is not a get rich quick scheme, but when done correctly over time, you could make a significant amount of wealth. And that is what we got exposed to and said, there is absolutely no way that we cannot go out there and do everything we can to educate members of our community about this opportunity. So that's how we're here today. I saw Becky come on camera, then ran away. So Becky, I think you want to come on and say something?
Don't be shy, guys. It's just us. Trust me, we don't bite. We can come on camera, This, I didn't even get a haircut, so I have this hat on. I don't want you guys to see my crooked line, my hairline.
Peter, thank you so much for your kind words. I appreciate you, brother. And again, thank you guys for joining us. Do we have any other questions? Anybody else that wants to come on camera and tell us what they do?
And if you don't want to come on camera, you just have a question, you can go get off of mute and then just ask a question as well. I'll put it in the chat. We still got, I think, 7 more minutes. So you got 7 more minutes to go before we
hello guys,
wrap it up here.
Jump in quickly.
Hey James, go ahead, man. Is that James or Tita?
Tita speaking.
Please go ahead, Tita.
Thank you guys for a wonderful event today, as always. Of course, I am very much far down the food chain, trying to see if I can get my feet on the road. It's just a learning experience for me. I happen to have got to know about Leslie, and he's been holding my hands and talking to me about what you guys are doing, and he invited me to this. And it's always a pleasure to come and listen to all the knowledge and wisdom And the question is, when you started, the three of you started this XSITE Capital, did you take some training, or how did you educate yourselves? And how did you come to a point where you were like, I need to do this and I have to jump into the water, because it's scary, you know, for somebody who is looking at the whole process and the whole journey and listening to you guys talk. This is a very scary kind of thing for me. Thank you.
Did I need me as a friend? Yes, we did. We did do a lot of. We signed up for mentorship program. We went to boot camps, read books, we listened to audibles, listened to podcasts. We immersed in ourselves heavily into. Spent a lot of money for education. And when you spend money for it, you're investing in yourself because you're building your identity and you're building your knowledge in it. So a lot of us went to school all the way to grad school. Some people got PhD. The reason why you're doing that is because you want to be an expert in a particular subject. And when we understood that this was available to us, that we can literally do it, we're like, all right, let's go learn as much as we can about it. And let's put people around us that can help us make sure that we don't fail. So to answer your question, yes, we learned a lot about it. And while we're doing these meetup is to start bringing that awareness to you as well, so that you become curious and then you start learning as well. And we're here to be a guide too. So if you have questions, we can answer this question. For example, some of the things we do in our community, like the free underwriting class, we paid heavily to learn that, but we give it to people in our community for free. And we provide a lot of this value and content for free as well. So this is how we continue to give back to our community. Leslie, you want to add something to it?
Yeah, I'm just gonna add, because let me preface by saying that don't go spend too much time that you have to educate yourself for like 2 years or get a PhD in multifamily investing before you take action. A big part of the education piece is action. When we discovered multifamily investing, when we read the first book about multifamily investing, the next week we registered a company. We started reading, figuring out, okay, what do you need to register a company and what you need to learn along the way. You take action, then you discover what you don't know and you go and learn it. We have fully really immersed ourselves into this over the last 4 years. I'm talking about, like, if you see me at the hospital, I always have my AirPods. I'm always listening to something. I always has to do with multifamily investing, or has to do with something or like business or mindset. So we have fully immersed ourselves in this, and while we're learning, you're taking action. So don't spend too much time, because especially for us medical professionals, Tita, especially for us anesthesia providers, that can lead to analysis paralysis, because we are trained to prepare for everything that might go wrong so it doesn't go wrong. And now when you come into the business space, you want to take that same attitude, but that's not the approach to take. The best teacher is action. When we started, I was the guy that wants to read every single book before I could do anything. But when an idea came, Tenny said, let's go, let's do this. I'm like, what are you talking about? He said, just go. Like the meetup, we heard, one of our mentors said, we got to create a thought leadership platform. We got to create a meetup. And I was thinking I needed to go do more research about a meetup, figure out what our audience is and all of that. Before I could even start coming with my plan together, Tenny had already registered a meetup and set up the first meeting. And I'm like, wait, what are you talking? I almost feed myself. What are we going to talk about? What are you talking about? Like, so much fear. He can remember when we started our first meetup, I was in panic mode. Like, who's going to show up? I was in total panic. I could not settle. What are we going to talk about? But something amazing happened. When we took that action, thanks to Tenny, registered this meetup and went over there, the very first person that showed up to our meetup is another operator that owns 4,000 units across the US. And he was just at the University of Maryland dropping off his daughter, and he was looking for anything real estate, and he saw that and he came. And he ended up being our keynote speaker for the meetup and gave so much value on our first meetup and became one of our mentors. That only happened because we put ourselves out there, right? So don't be so intimidated by this. This is one of the reasons why we do this, because, again, don't see the $168 million and get intimidated. We all started somewhere, and that somewhere was zero. Nothing. All we had was our respective degrees that we had, and like a minimal single family home investing experience. That's all we had. But we saw an opportunity that we thought was very important that we brought to our community, and we made the commitment to go in and put in the work to do it. So a combination of education and action is what is going to get you there.
Absolutely.
Thank you both very much. I'm really grateful.
You're welcome. James, you were on camera?
Yeah, can you guys hear me and see me?
Yes.
Yes, sir.
Okay, all right, great. Yeah, my name is James Pitsia. I'm an internal medicine physician. I actually graduated with Julius from Howard 2006. So
wow,
impressive to see what he's put together. I'm really impressed.
Okay.
But my question is, with the example that you guys gave with the view, I mean, it seems like COVID kind of created like an interesting real estate market, right? I mean, is that what you guys are expecting? And for how long do you think it'll be that way to get return so quickly?
A lot of that, even prior to COVID, like between 2016 and 2021, that was mostly the length of most business plans, because cap rates were compressing, rents were growing in most Southeastern markets. So most deals, most multifamily business plans were going just like 2-3 years, and good operators were able to exit within a short period of time. But that has changed completely now with the Fed starting to increase interest rate and trying to push the economy into a recession. So while multifamily remains fundamentally strong, I was reviewing the Lineman letter today, which goes into more detail about the economy. There's still a lot of capital on the sidelines, like billions upon billions of dollars. Actually, $3.2 trillion is still in banks. Out of that, about $880 billion is on sidelines by like by real estate investment funds, just waiting for the interest rate climate to settle in to start going back into multifamily, to start buying assets that have yield. I personally think the returns will shrink a little bit, but there's still going to be great opportunities to make double-digit returns in multifamily in particular, in specific markets. So that's good. Just most of this capital is just waiting for the Fed to get to the point where they say, okay, yeah, no more rises in interest rates. This is where we are. We're happy where things are. Then they'll start coming into the market. But I don't think like this kind of trifecta of increased rent growth because of inflation and COVID and all of that, we're going to see that again in the next few years. The next few years are going to be the year of the operator. This is where people that operate really well, that have conservative business plans, are going to do really well. But we're still going to be able to produce some great returns on multifamily because the fundamentals remain strong.
Okay, thank you.
Yeah, the expectation is for us to hold longer now.
Yeah,
not 2 years turnaround. Because like Manny mentioned on his conversation, a lot of markets used to do double digits rent to growth projection, 10%, 5%, 6%, and whatever. Now we're doing 1% and 2% rent growth, plus the organic rent growth that we see that each market has, which is like 2%. So because of that, you will not be able to kind of, do the appreciation too fast. So a lot of conversation we're going to be having with our investors is, hey, if we say, 5 years, it's probably going to be 5 years. If you say 10 years, it's probably going to be 10 years. So yeah, that's what it's going to be going forward.
I see. Okay. Yeah, that was actually my next question. Okay, great. Thank you.
Oh man, that was really on mine. Please, next question. Thank you so much for that question.
Anybody else? It's 7:32. If we don't have any other questions, we're gonna give everybody's evening back. Just gonna end by saying that on behalf of our CEO, Dr. Julius Oni, my other partner, Tenny Tolofari, and our amazing team, Miles Hill. Go ahead.
I have a question.
Hey, I got a quick question. I know that on you guys' first your first return on investments, from what you guys told me, you had a projection of about 6 months. Sorry, 6 years. Is that correct? But
5
then
years.
you were able
5 years.
5 years.
I went in 21 months.
Yeah, but then you were able to get out of it in 21 months, correct?
Yes.
Yeah.
Okay. In your future, where do you guys see the market? Is that an anomaly, or is that something you think some of your projections have, or some of your current properties Do you guys see that happening with some of your current investments, or is that just an anomaly that happened during that COVID time?
So even before COVID, we told our expectation as an investor is if the business plan is 5 years, expect that your funds are going to be locked in for 5 years. But like we evaluate the market every year to see if it's appropriate to exit or make any kind of changes. So it might happen in some of our assets, but we are now favoring longer term holds, nicer properties that we could hold long term, because that is really where you generate generational wealth, by being able to hold these assets for a long period of time. But we're going to have some assets that we're able to exit in 3 years or 4 years, but most are going to be longer term holds. All right. All right, again.
Yeah, give your final speech now.
My final speech again. Again, on behalf of our CEO, Dr. Julius Oni, and my other partner, Tenny Tolofari, myself, our amazing team, Ms. Macy Price, Mr. Miles Hill, Ms. Kayla Daughtry, and our amazing on the right, Mr. Manny Awasom. We say thank you so much for joining us this evening. We truly appreciate you, and we are glad that you're part of the XSITE community, and we look forward to continuing to provide value to you. Thank you, everybody, and have a wonderful night.
Thank you all so much. Appreciate the time. See you next time.